The $64 trillion question today isn't about geopolitical stability or even inflation. It's the fundamental cost of money itself. The Bank of Japan has just slammed the door on the era of cheap yen, hiking rates, and triggering a structural reversal in global finance that, frankly, Washington seems utterly unprepared for. This is Neural Pulse. Let's analyze.
Today's deep dive is really into the synchronization of multiple global crises. I mean, you could call it a true polycrisis. We're synthesizing sources across 4 key domains where you can see structural risk just mounting simultaneously. We're talking military escalation spilling into major trade routes, a deep reversal of global finance, the growing cyber confrontation between great powers, and then these profound paradoxes within consumer confidence data.
Right, and the core mission today is to deliver clarity. The central theme that just runs through everything we're seeing is this increasingly sharp divergence between market optimism, which is, often fueled by political talk and hope, and the operational reality, the reality dictated by hard financial numbers and, well, military facts on the ground. We need to understand not just what is happening, but why the world seems to be failing to price in these risks.
And there's no better place to start that analysis than with the most impactful structural shift of the past week: the end of Japanese exceptionalism in finance.
Okay, let's unpack this financial shock because the numbers are stark. The analyst data is clear. The Bank of Japan raised its policy rate to 0.75%. I mean, that's the highest level we've seen in 30 years. It officially ends a very long, very comfortable era of zero and even negative interest rates in Japan.
And what makes it so critical is the timing. It's an immediate and sharp decoupling from the U.S. Federal Reserve. While Tokyo is tightening policy, Washington is easing. We saw the Fed simultaneously lower the federal funds rate to, 3.50% to 3.75%, and they're citing genuine concerns over slowing domestic growth.
That divergence is the pressure cooker. When Japan raises rates while the U.S. lowers them, the tightening spread between those two key rates just maximizes the pressure on the structural carry trade. And we saw the immediate reaction, right? When Japan hiked, it directly pushed the U.S. 10-year Treasury yield up to 4.14%. How significant is that jump specifically in terms of global bond market liquidity?
Oh, it's massively significant. It basically telegraphs the structural collapse of what we call the yen carry trade. For decades, this wasn't small money. This was the foundational engine for global liquidity. Investors could borrow yen for virtually nothing and then park that capital in higher-yielding dollar assets. It funded everything from U.S. real estate to emerging market debt.
So if the cost of borrowing yen is suddenly shooting up and the interest rate differential, the profit margin is shrinking, what's the mandatory financial reaction for those big institutional funds?
They're forced to unwind those positions, and they have to do it quickly. This triggers massive capital repatriation. So to unwind the trade, they have to buy yen back, which forces them to simultaneously sell dollar assets, mostly U.S. treasuries. That selling pressure drives down the price of treasuries, which is why we saw that immediate spike in the 10-year yield. The whole system is structurally shedding dollar assets to hoard yen.
That sounds incredibly volatile. I mean, we're talking about trillions of dollars that underpin the U.S. bond market being unwound. How quickly is that wave cresting? Are we talking months or quarters?
The initial shock is instant, but the structural unwind, that takes quarters, maybe even years. But the timing today is what's so critical. This reversal of global capital flows immediately raises borrowing costs for the incoming U.S. administration. Trumponomics 2.0, as it's being called, relies heavily on massive-scale deficit spending and debt issuance for its proposed fiscal expansion, sweeping tax cuts with huge infrastructure projects.
That's a fascinating unintended consequence. Tokyo, just by trying to stabilize its own financial system, is inadvertently constraining Washington's fiscal freedom just as the U.S. is preparing to open the spending spigots. Essentially, the price tag for U.S. debt just went up globally.
Exactly. The cost of money is changing the domestic political calculus in Washington.
And that rising cost of capital directly impacts how you fund global conflict. So if we follow the money, it leads us right to how the war in Ukraine is expanding its geographic and economic footprint. It's spilling far out of the Black Sea and into the Mediterranean now.
That's the logical next steps. The conflict has achieved a dramatic new long-range reach this week. It's something that decision makers in Europe simply cannot ignore.
Let's get to the facts of the strike. Ukraine's SBU conducted its first successful maritime attack outside the Black Sea. They struck a Russian Shadow Fleet oil tanker, the Quendel, in the Mediterranean. Our data shows this was executed about 2,000 kilometers from Ukrainian territory. That range alone is a major statement.
It is. It's a critical expansion of the theater of operations. This attack targeted the so-called Shadow Fleet, which for our listeners is about 1,000 older, often uninsured tankers. Russia uses this fleet specifically to bypass G7 price caps and sanctions, mostly shipping massive amounts of crude oil to markets like India and China to sustain its war economy.
And while the specific tanker, the Quendel, was reportedly empty at the time, it was disabled. So militarily, this is a huge win for Kyiv. It demonstrates undeniable long-range capacity to disrupt Russia's income stream. But strategically, that disruption seems precarious. What's the key risk here for Kyiv's Western backers?
The risk is existential to Western support. If an environmental disaster, a major oil spill, were to happen in the Mediterranean from one of these strikes, it could just torpedo Western public support for Kyiv. That whole region is so densely populated it depends on tourism and fishing. Environmentally conscious European allies could quickly pressure their governments to halt support if the war spills over in a catastrophic ecological way.
So a high-stakes strategic gamble. Now, contrast that successful military action with the parallel political failure we saw in the EU regarding funding.
Precisely. The European Union agreed to a massive $90 billion loan for Ukraine. On the surface, that looks like a great show of unity and enduring support. However, they simultaneously failed to agree on the legally and politically thorny issue of using frozen Russian assets to fund that aid.
Right, so instead of seizing the assets, they settled on a loan backed by the EU budget. Why is that failure to use the frozen assets such a serious paradox? Doesn't the money get to Kyiv either way?
It's a paradox of leverage. This failure to legally seize and use Russian state assets, which are worth hundreds of billions, sends a clear signal to Moscow. It tells them that Western financial retaliation has significant legal and political limits. If the West is unwilling to cross that legal red line and seize the funds permanently, it creates this perverse sense of security for Russia about its frozen funds.
Essentially, they know the money is safe, just temporarily inaccessible.
Correct. It weakens the long-term leverage of the entire sanctions regime and gives Moscow a financial playbook for future conflicts, knowing their state wealth remains structurally protected.
This military escalation in the West, with Ukraine expanding its theater, it aligns perfectly with this mounting strategic friction between great powers in the East, particularly when you look at high-tech strategic assets and asymmetric capabilities. Let's turn to the increasingly tense Taiwan cyber nexus.
This is where the quiet confrontation is escalating rapidly, both kinetically and digitally. It shows that both sides are actively preparing for a potential future conflict.
Okay, let's look at the facts on Taiwan's defense. The U.S. just notified Congress of a record $10 billion arms package to Taiwan. This includes critical defensive systems like HIMARS and, crucially, ATACMS.
The inclusion of ATACMS is the key here because of its range. Its 300-kilometer reach gives Taiwan the undeniable capability to directly strike Chinese coastal aggregation points. We're talking ports, airfields, staging areas. Before any large-scale invasion can truly launch, it dramatically shifts the geography of Taipei's defense.
This move definitely supports Taiwan's Porcupine strategy, making the island too dangerous to invade. But this military strengthening comes with a massive, very transactional financial demand from the U.S. side. The incoming administration is requiring Taiwan to raise defense spending to 10% of GDP.
That's a nearly threefold increase. It far exceeds their current plans of about 3.3%. This turns defense into a transactional cost that will put immense financial strain on Taipei's domestic economy. So while the U.S. offers the hardware, they're forcing Taiwan to absorb the massive budgetary costs of maintaining that deterrence.
And that military tension is mirrored precisely in the cyber domain. It really shows that the planning for a Taiwan contingency is actively underway.
Which brings us to the UK Foreign Office hack. This wasn't just some low-level espionage.
The UK Foreign Office officially confirmed it was successfully hacked back in October by this advanced persistent threat group, Storm 1849. And intelligence links this group directly to China's Ministry of State Security, the MSS. Why is this more systemic than just, standard information theft?
Because of their known tactics and specific targets. Storm 1849 is famous for exploiting zero-day vulnerabilities in critical Cisco network devices. For our listeners, a zero-day vulnerability means it's a flaw that the device manufacturer Cisco, in this case, doesn't even know about yet or hasn't had, 0 days to fix.
So China discovered this flaw or bought access to it and used it to breach a high-level government network before anyone else knew it existed.
Precisely. And this suggests a goal far beyond simple information theft. Their primary goal is pre-positioning malware. They want it deep within government and critically defense infrastructure. They aren't just reading the emails, they are setting traps.
Meaning they aren't looking for real-time intelligence. They're planting timed bombs to be activated during a future flashpoint.
Exactly. They are stealing the network administrator keys now. They are preparing to activate this malware during a future contingency, say a Taiwan invasion, to instantly blind or shut down their opponent's military communications and logistics. This is strategic warfare readiness. It's designed to achieve kinetic advantage through digital means.
These systemic risks, financial volatility, military expansion, cyber warfare readiness, they're all clearly visible to intelligence circles, yet the markets appear remarkably detached. They're still pricing in explosive growth based heavily on political optimism. Let's look at two key areas where reality is just diverging sharply from expectation.
The dissonance is strongest in Washington, where the internal conflict over the future of financial regulation is already visible in the incoming administration.
We're talking about the financial regulations civil war brewing between Treasury Secretary nominee Scott Bessent and Senator Elizabeth Warren. What's the friction point here?
The friction is intense, and it centers on global banks. Warren is demanding disclosure regarding Bessent's alleged promises of deregulation to large global systemic banks, GSIBs, like UBS. The core accusation is that Bessent is actively encouraging them to move their headquarters to the U.S. by promising a far lighter regulatory touch than they face in Europe or elsewhere.
And the interpretation of this clash is crucial because Bessent is championing what he calls a new golden age, fueled by deregulation, capital inflow, and growth. He argues this will cement the U.S. as the undisputed global financial center.
But Warren, conversely, is waving the warning flag of 2008. She's warning this invites too big to fail systemic risk. If these massive global banks move their centers of gravity, their risk management, their capital to the U.S., they will effectively force U.S. taxpayers to backstop the next global financial crisis.
Why should the average taxpayer care about where UBS has its headquarters? What's the direct risk?
The risk is moral hazard. If a massive, globally interconnected bank collapses, the administration will be forced to bail it out to prevent systemic collapse. Warren's point is that the market is cheering the growth potential of deregulation, while historically ignoring the inevitable pattern of that excess, leading directly to collapse, leaving the taxpayer holding the bag. It's a fundamental philosophical battle over safety versus expansion.
And we see that same type of dissonance playing out vividly in consumer markets, specifically between crypto and luxury goods. The data dive is genuinely contradictory.
Let's start with crypto. Bitcoin is consolidating near the $88,000 mark. That's a strong, high number, indicative of bullish momentum. Yet the market sentiment fear and greed index remains stubbornly in extreme fear.
How do you even reconcile that? A booming price with extreme fear, it just doesn't compute.
It's the definition of a paradox driven by psychology. Investors fear missing the rally, fear FOMO, fear of missing out more than they fear an actual crash. They're climbing a wall of worry. They're betting entirely on the political tailwind of the incoming administration to override any underlying fragility. They believe the policy shift will guarantee growth regardless of the fundamentals.
Now look at the high-end luxury market. It's often a strong signal of global wealth confidence. Stocks for brands like LVMH and Kering are seeing a recovery driven entirely by investor expectation of a significant 2026 China market bounce.
But the operational reality on the ground in China is far different. The China Consumer Confidence Index is low, stagnating around 89.4. Consumers there are defensive, pessimistic, worried about the ongoing property crisis and long-term employment. Investor hype is completely disconnected from consumer spending.
And the most concrete signal of corporate pessimism comes from Kering itself. They just sold a 60% stake in their flagship Fifth Avenue property for $690 million just to raise cash.
That's the disconnect made tangible. Kering's management is selling a valuable, non-core asset for immediate liquidity. This strongly suggests that corporate leadership is far more pessimistic about an immediate China rebound than the investors buying their stock based on future recovery hopes.
These data points, the fearful Bitcoin rally and Kering's asset sale, are twin signals of deep financial instability masked by short-term political hype.
We've discussed where the money is moving and where the great powers are confronting one another, in finance, military, and cyberspaces. But we need to close this brief with a critical reality check on the forgotten hotspot that could trigger a regional catastrophe. We must bring urgent attention back to Sudan. While the world's focus is understandably on other flashpoints, the siege of El Fasher in Darfur has reached a catastrophic human level. This is a tragedy unfolding largely outside the global media spotlight.
The The facts on the ground are grim. Our source reports indicate 70,000 to 100,000 civilians are trapped inside the city. And essential infrastructure, hospitals, water, power has, quote, completely vanished. Worse, there are clear reports citing ethnic cleansing and systematic atrocities by the Rapid Support Forces, the RSF.
And the potential fall of El Fasher is a disastrous regional domino effect. This is not just a localized civil war, it's a proxy war being fueled by external powers. You see Russia and the UAE providing critical support to the RSF, while Egypt and Iran are approaching the Sudanese armed forces, the SA. This external fueling just prolongs the conflict and elevates the violence.
So if El Fasher falls, the risk of massacres is extremely high, and the implications for stability go far beyond Sudan's borders.
Absolutely. The mass displacement will generate huge, immediate refugee flows into Chad, a country already struggling with immense fragility. More importantly, the governance vacuum created by this continued civil war and state collapse will accelerate the spread of ISIS and al-Qaeda-linked groups throughout the entire Sahel region: Mali, Niger, Burkina Faso.
So we're looking at the creation of a massive, lawless corridor of instability that could be a generational problem for the entire African continent and a new front for global counterterrorism efforts.
Precisely. That is a critical warning that global decision makers cannot afford to ignore, even amidst all the noise from the other flashpoints we've discussed. The instability created here demands global contingency planning immediately.
When we synthesize all the source material today, you just see the world being pulled sharply between the buoyancy of political hope, the promise of a golden age and quick fixes, and the sheer gravity of structural reality. The delayed yet massive effects of the yen carry unwind, the silent danger of cyber prepositioning, the expansion of war into vital maritime and humanitarian zones. These will be the primary features of the global landscape in early 2026. The confluence of these complex, simultaneous risks demands urgent and comprehensive contingency planning because the crisis clock is ticking on multiple fronts, globally.
Merrill Pulse. Clarity in a complex world. See you tomorrow.